Computer. Welcome back to the CoWaCo. We in the building. And today we're going to actually start off talking about Chris. What we're going to start off to talk about?
This is what we're going to do. Appreciate you, Sensei. Thank you very much. That's Leroy. I'm Chris. He didn't say it today, but look, like, comment, subscribe. You know, I don't really, go ahead and do what you want to do, but just get the information and go home. So let's talk about dividend statuses, okay? So in a few videos ago, I mentioned dividend status stocks, or the various dividend statuses. So in this video, and I promised that I would elaborate it on it in a further video. So this video is that one. So the first dividend status stock that I want to mention is called a Dividend Aristocrat. That is a company that gives a dividend for 25 consecutive years at an increasing rate, or a company that increases its dividend over 25 years straight. It has to be an S&P 500 company, so it has to be in the Standard & Poor's Top 500, and it's typically companies that are well established and companies that are somewhat recession-proof or mostly recession-proof. A dividend king is a company that has given an increased dividend over the past 50 years. So these are your 3Ms, your ABBVs, your Coca-Colas. Walmart is now technically, but Walmart is also a part of that. The 2021, Walmart was in its 49th year of consecutive dividend growth, and wasn't quite qualified yet to be a dividend king, but it is now. And there are several other companies that qualify for that. Again, has to be in the S&P 500, and most of these companies are highly recession-proof. So these are companies that are going to function whether the market is up or whether the market is down. There are some unofficial, if you will, dividend statuses. This is Dividend Champion, Dividend Challenger, and Dividend Achiever. So these unofficial titles are, you'll find them on different blog posts, the definition for them. But a dividend champion is a company that has given a dividend, an increasing dividend consecutively for 25 years straight, but it does not necessarily have to be in the S&P 500. So this could be a company in a larger index that just so happens to give an increased dividend over the past 25 years for the consecutive past 25 years. A dividend challenger is a company that has been given dividends for at least 5 years. This company also does not have to be in the S&P 500. And it is typically between 5 and 9 years. And typically these companies have pretty big market caps. Over 3 billion in a lot of the blogs is where they start counting that. But a dividend challenger is a company that's been giving consecutive increased dividends for at least 5 years. And then a dividend achiever is a company that has, again, these three are unofficial classifications of dividend statuses. So they're in many financial circles, but you won't find them on Yahoo Finance or, ETFDB or Investopedia, these various outlets that allow you to look up the definitions for these words. But a dividend achiever is a company that has been given a dividend consecutively increasing over the past 10 years. And again, does not necessarily have to be an S&P 500 company. So these are the different dividend statuses. The two official ones that are recognized: Dividend Aristocrat, a company that has given an increased dividend over the past 25 consecutive years. S&P 500, highly recession-proof. And then a Dividend King, a company that has given an increased dividend over the past 50 consecutive years. S&P 500, highly recession-proof.
Okay. All right, that's pretty cool, man. And I see Walmart actually was giving dividends for at least 47 years.
Yeah, well, last year was the 49th year. So they would qualify at the end of this year for a dividend king if their dividends increase. Okay. So if Walmart's dividend this year is greater than what it was last year, which by default will make it greater than the previous 48 years, then Walmart will be a dividend king. Okay. I suspect that will probably come up sometime in the news just to boost Walmart stock. I mean, Walmart is a favorite of mine, but you know,
I'm Target fan.
I suspect that'll come out. Right. Well, and Target is a great company. It is. It is.
Target and they also offer good dividends too.
Yes, it is. Target is a dividend king. Yes, it is. Yeah.
It's at 50. I like Target.
Yep. Yeah. Yep.
Yeah. Okay. All right. So I just learned something today myself. Just let y'all know.
Yeah. I mean, and look, so both Walmart and Target are in the I believe they're in the consumer staples.
Mm-hmm.
The XLK. They're in the XLK ETF, the consumer staple ETF. So you know, brilliant.
Oh no, not XLK, XLY.
XLK is technology. XLY.
Yeah, XLY. Yeah, they're in the XLY ETF. Yeah, okay, they got a nice amount of because I was looking at when you was talking about how you pronounce a Dividend Aristocrat. Okay, yes. I was just looking at the list here, and it's just interesting seeing most of these companies actually on here. Coca-Cola is on here. Coca-Cola is given for 59 years.
Right.
That's a long
time.
So
technically, if you're on the Dividend Kings list, by default, you have to be on the Aristocrat list because you're surpassed. Well, actually, no, let me not say that. Actually, no, yes, let me say that. If you're on the Dividend Kings list and you've been given an increasing dividend for 50 years, obviously you've been given it for 25 years. So, but at least 25 years is not 50 years. So a company, obviously, that's been given dividends for 27 years, and it's been increasing every year for those 27 consecutive years, they're not yet a king, but they are an aristocrat. Okay. So, yeah, you know, right. So you'll see, you can match the latter with the former, but not the former with the latter. The king is an aristocrat, but an aristocrat is not a king. So it's chess.
Chess. Right? That's what I'm talking about.
Right, it's chess. Yeah, it's chess, which is a great game. Go play it. It really does work the brain. Oh, yeah, but yes, those are the different companies. Those are the different companies.
Okay, all right. So next we're moving on to talking about basic analysts of a company's chart.
Yeah, the basic analysis of the company's chart. So
I apologize.
Yeah, I was looking. So I wanted to bring this up to express the importance of just looking at company charts. You know, if you're in the financial world and if you're interested in acquiring more knowledge about it. And, you know, of course, the old adage is as long as the chart is moving left to right, going up, then you have then the trajectory is good, you know, because that's how the entire stock market operates like that. From its inception to now, when you step back up, you take a look at the chart, if you put it on a wall, it's going to start here, this is my left, and it's going to go up here, right? It's going to, where we are now today. So you want to see that same trajectory for companies that you're interested in. So basic analysis would say, okay, even if you look at where a stock finishes at the end of every year, I know we will get into candle wick, or, you know, the wicks on the different charts, where the company opened, where it closed that day, everything in between, about where it stayed. I know we'll mention that down the line somewhere, but basic analysis, picking good companies. You want a company that starts here and goes here and continues to climb. Yes, once you zoom in and you'll see like, oh, okay, I'm focused here, this section of time, whatever, this 6 months, this 10 months, this year, it was down, it did it, but after that, it recovered and it went up and it went back up past where it fell, right? But when you zoom out and you look at a chart here, you want to see that trajectory going up. So basic analysis of every stock that you're looking at, you want it to go up and to the right. You want to look at where a company finishes each year, where it starts each year, and then you can look in between. So when you're just beginning, if you just want to get the basics, look where a company started, January 1, look where it ended, December 31. Pick a day in between sometime in the summer, June, July, to see where the company was in June, July. Compare that to the other years of the company. I mean, just pick those 3 dates, right? If you pick a date in the middle of the summer, it should tell you where that company is going to end up at the end of the year, right? It's been 6 months. Company's been doing well, or the company's been doing this. What are they going to announce? What are they going to do? And it should it should inform you where the company is going to go for the rest of the year. Because I have to roll out winter plans in the summer, right? I got to roll out spring plans in either the winter before or nearing the end of winter, right? So basic analysis, top of the year, bottom of the year, where did the company end? Where did it begin? Where did it end? 10-year trajectories are always a good thing to look at. What has the company done over the past 10 years? How has it performed? And then 20 years, the same thing. If the company has been around for that long, this company's been here for 20 years, how has it done? This company's been here for 10 years, how has it done? And that will give you if a company in 2010 is worth less now, if a company is worth more in 2010 than what it's worth now, probably not a good investment, right? Definitely not a good investment. Let me go ahead and affirm that. Definitely not a good investment. 10 years is enough time for any company to do extremely well. So over a 10-year time span, and you decide your percentage if you want to get in the company or not. If the company doesn't give at least 10% a year, and that's your threshold for the company, and you won't get in on a company that gives less than 10%, don't get into that company. Right? But when you look at the past 10 years and you look at the average time that this company, when you look at the average percentage every year that this company has returned, and it's 30%, 20%, whatever. These are obviously amazing companies, but if it's 10, 15, 20%, then go ahead and invest your money in that. But that's the importance of looking at companies, and that's just a very, very basic analysis of a good company, and should allow you to, should allow you the ability to say, okay, is this an investment for me or is it not?
Right. And this understand also too, I always say that a chart tells a story. And the reason why I mention that is because there could be like something that actually happened, during the particular time, like a company is running, and like maybe like supplies have gotten a shortage on supplies, and basically that caused some type of issue of the company getting supplies. So then that causes for productivity to actually fall on that particular company. And then so once you see that has happened, and when you go look back at the chart, you're like, oh, it dropped on the chart. Well, what was that story? The story was had less supplies. So just keep that in mind. Like companies does go through some rough times, but again, as you mentioned, the ones that actually are solid, they're going to pull out those hard times, because they're going to figure out basically what to be able to actually do to keep the business going. So just keep that in mind also too.
Exactly.
All right. So we're wrapping it up here. Now we're about to do our stock picks.
Yes, sir.
Yes,
sir. The favorites of the week.
Favorites of the week. Yeah.
Yes, sir.
So.
Yes, sir.
Let me get my app open here, because each time when I'm getting you all, favorites, I'm letting you all know like what companies I've actually have invested in on my Cash App.
Right. Yeah.
Or what I'm putting money into each week. Now some of them won't be on my Cash App, that I actually would say that are still, good companies, because sometimes you actually do companies that fit your personality. But as long as they're good companies, they're solid, good companies, that's your personality. That's who you are as an individual.
Right. Yeah. And you want those companies, like I mentioned earlier with the analysis, you want those companies with an upward trajectory. And I know I mentioned last video, take the emotion out. You're going to hear that a lot because a lot of people are getting highly emotional about their investing, and you're hearing a lot of expert investors and a lot of financial advisors letting people know, hey, it's okay to drop a company from a portfolio or stop investing in a company, or not even not even get a position in the company because it's not doing well, right? Like, yeah, okay, you might have grown up on their products, but if the company's not performing well, it's not a good investment. The purpose of money is to bring friends with it. You want your money to multiply. You want your money to have a lot of friends. So that's the importance of that. But so you have your stock, you got your stock picks, Leroy?
AMD.
Oh, you put it up. Okay.
Yeah, AMD is one of them. And also the Cornstar Group. Cornstar Group, it actually is a company that any like website that you can think about that deals with real estate, they actually possibly own that website. So that's why I like the Cornstar Group. And matter of fact, Cornstar, they had a stock split that they did. I think it was like a year and a half ago. Where their stock was like $800.
Yeah.
To be able to actually invest in it. So they did their stock split and bring it down. I think they did like a 10 split, 10-1 stock split. And so AMD, Cornstar Group, and I'm going with my other chip company too, NVIDIA.
Perfect. Well, on this day of this week, of this month, of this year, I'm going to be the ETF guy. So my stock pick this week is XLI. But I want to focus. Yeah. I told you I'm an industrials guy. So the companies inside of there, though, that I'm liking, John Deere, Caterpillar, and 3M. 3M is probably going to be my stock pick for a while, just because they've been giving dividends 67 years. The company's going to be here. It's going to be great. And XLI is really for me a dividend portfolio or a dividend ETF. It's really, that you can use it for that. It's not a 300% return every year, 400%. It'll get you 10, 12, 15. Boom, and you're good. But I want to pick those three companies in there because they have had some great growth. John Deere has had some fantastic growth over the past 15 years, upwards of 350%. So that's amazing to have something like that. That's 20 plus. What is that? 20 plus percent, 25%. That's amazing growth every year. Caterpillar, of course, is my favorite company, and they've 100 90% growth over that same amount of time. And Triple M is 120. It's in that range between 100 and 125. But 3 great companies. They're gonna be here. They're gonna be fantastic. I was gonna pick UPS again. What can Brown do for you? But it's in there, so we're good. But this week, my stock pick is XLI, the Industrials ETF. It's at $93 and change right now. Perfect investment to get in there and just wait for it to run up.
All right, you all. Like, subscribe, comment, and share. This is the end of the CoWaCo, the company water cooler.
All right. Till next time, y'all.
Peace.